Welcome to the PlanStrongerTV market update for Wednesday, April 22nd. Let's review the numbers, and we've got lots to talk about. So, taking a look at the indices that we track and comment on, you've got the Dow up 2.75%. Total stock market index a little better at 4. You look down the line there, S&P, NASDAQ, standout small caps. We'll talk about that in just a moment, up almost 12%. And then foreign stocks, not to be too far outdone, almost 10%, and bonds kind of hanging around flat for so far year to date. So we'll dive right into some commentary with Robert. Robert, we looked at the list, and if somebody waking up on April 22nd, they would never know that we had a dip, a pullback, and almost to the point of a market correction during the first quarter. But the markets are back, and looking at a couple of these in particular, foreign stocks and small cap, I'll take those returns right now for the year. And so, what is your first reaction to how the market has responded so strongly in coming back up?
Yeah, I'm going to extend your analogy. If you just woke up, assume that after a full month of conflict with Iran, which started the last day of February, Saturday, February 28th, through March 31st, if you went to bed on April 1st, you saw, and the last time we did a commentary was April 1st, and we looked at year-to-date through March 31st, 6 of those 7 numbers were negative. Those were painted red. So 3 weeks later now you wake up like, oh my gosh, what has the market said? And we're in the positive territory in a lot. And you mentioned small caps especially. So, it's, of course, there are problems in the world, there are conflicts in the world, we're engaged in one right now, but life goes on, markets move forward, things can be bad, volatility happens, but looking at the returns of the markets, things may not be nearly as bad as a lot of news sites may hint at.
Fair point. I mean, the media is, as I've said many times on the update, and if you've watched the television program, the media's job is to sell your eyeballs to their advertisers, and that's what they do. And they do that by, talking a lot about what the market's doing, and maybe how things are bad, and you got to watch and stay tuned. But, kind of as a corollary or another point here, Robert, is small caps being up 11.78%. year to date, and that's a raw number. That's not annualized. And foreign stocks right behind it at 9.7%. Here are 2 parts of what most investment advisors, money managers, investment managers would say are ingredients or a part of an overall diversified equity or stock portfolio that candidly do not get a lot of the focus of our hyper attention on large caps. Yes. And the Magnificent Seven and the S&P 500 and the Dow. These 2, here you go. This is a textbook example of why the diversification into these other areas is so important, because miss a day, miss a lot, miss 2 weeks, miss a lot.
Absolutely. Yeah. And you look at small caps, more than quadruple what the Dow Jones has done, more than double what the NASDAQ has done, more than triple what S&P has done. So yeah, diversification, especially when these things, these sectors such as international emerging markets, small caps, show strength over not just months, but perhaps a year, year and a half, 2 years, you're missing out on a lot not being diversified.
Yeah, I'd like to ask the judge to go ahead and move to a jury verdict that the case for diversification has been made with small cap and foreign stocks performance year to date. Okay, so moving to the other topic we want to make sure we got to, Robert, is inflation. We haven't heard as much about the inflation story or interest rates because, of course, the media and the news cycle focusing so much on what you call the Iran conflict, which is, it's a conflict, but it's, rather one-sided. So where do we stand with inflation and expectations about interest rates? Is that affecting some of these numbers we're seeing?
Absolutely. Yes, they are, especially small caps, and I'll tie that in a moment. But so, we have the CPI and the PPI and the the PCE, which is the Fed's preferred inflation metric, which stands for personal consumption expenditures, what consumers are actually spending. But instead of just focusing on that whole number, there are various Federal Reserve banks that have their own metrics, and I want to point out two of them. So the first one I want to look at is the Dallas Fed's 16% trimmed mean. I know that's a mouthful even for me. So what the heck is Dallas Fed's 16% mean? So what that does is it cuts out the highest price movers and the lowest price movers. Basically, it eliminates the outliers of goods that have rose the most or fallen the most. And here's what they found. The 1 month annualized trim mean is down to 1.82% from 2.71. I'll say that again, 1.82. That's below the Fed's 2% target. The 6 month annualized rate dropped to 1.99%, the lowest since March of 2021. And finally, the 12-month, the last 1 year, the trajectory is still downwards, hit 2.33% when, again, also lowest since 2021. So that's kind of one metric. Another metric I want to focus on is the Cleveland Fed's median PCE. So what's the median? The very middle point. With that, the year-over-year median slipped to 2.79% from more than 3.4% in the middle of 2025. So the 6 month annualized median PCE fell to 2.25%, again, the lowest since April 2021. So you have these two different metrics, David, showing a downward trajectory. And let me end with a quote here. What these two measures are telling us is straightforward. The February acceleration in headline and core PCE was driven by outliers, not by broad-based pickup in price pressures. A handful of categories, recreational goods, clothing, other durables, printed big numbers, but the typical price change in the economy actually got smaller. So we're seeing a downward trend now. Yes, inflation is still a story. Energy prices, even though oil got up to 120, it's back down to 90 and falling. So of course we're going to have volatility with the Iran conflict, but it's kind of our job when the media is hyper happy with things. We have to say, hold on, here's some cracks in the economy. But when also the media is hyper that things are going to hell in a handbasket, David, we have to say, hold on a minute, let's look at the actual data.
Right, fair enough. So our take here is to be not necessarily contrarian, but just to be real about it and look at more of we say this all the time, look at the data. Look at the underlying data. Every time I do a talk and somebody asks me about the market, I'm like, look at the percentage drop or decline. Drop is even too strong of a word. Look at the percentage increase or decrease mathematically. Points and other things that they talk about in the media can get us off track and make something sound better or worse than it really is. And so I like that, Robert. And I think I'll go out on a limb here based on what you said. I don't see the Federal Reserve changing interest rates. I think they're going to stay where they are because they're seeing the potential for inflation to come down a little bit, may come down a little more. We've got these spikes in different areas. Energy is still an uncertain thing. And I think that they're going to want to keep their powder dry, meaning they will keep rates where they are so that if things do take a negative turn, they've got just the adrenaline to put into the patient to try to revive it as a way of stimulating the economy for them to lower rates now. While that would reduce borrowing costs for millions and millions and millions of Americans, they're going to want to keep that in reserve, no pun intended, at the Federal Reserve so that they can act when they feel like they need to. So I don't see a rate cut coming.
I'm going to back up what David just said with data. According to CME FedWatch tool, at which I looked to this morning, at every Federal Reserve meeting this year, over a 50% chance at every meeting that the rates are going to stay the same. So that's data backing up what you said, David. And one other thing I want to add to tie in small caps with what we've talked about with inflation. Small caps. The reason they are going up is because small capitalized companies are most affected by interest rates and yields and borrowing costs. if they have gone up 12% more than any other asset class, small cap companies are looking at inflation and kind of seeing what we've talked about and saying, you know what, the hype that, inflation is going to explode or what have you, the 2,000 small cap companies that index tracks, they're saying they don't buy it.
So they might not be expecting a rate cut, but they're certainly more comfortable with, they're very unlikely to have a rate increase. And so they're like, all right, so the rates we got are what we got. We're going to make plans. For them, it actually creates a sense of certainty. Yes. And small businesses, as well as big, but especially the smaller the business, the more the certainty allows them to make financial decisions and business decisions about how to grow that company, especially for the publicly traded ones we're talking about, who answer not only to the management and the insiders, but also the public who are investing in their stocks.
Exactly.
All right, any other final thoughts?
Nope, I just had my 2 final thoughts.
All right. So Robert's already stuck the landing. We'll wrap right there. We'll continue to monitor the situation, and we'll be back soon to help you continue to plan stronger.